This is a holistic and professional plan to try and make money trading and investing in crypto. This video is full of strategies, tips, resources, areas that you can go and study yourself so that you can be very confident in trying to take advantage of cryptocurrency cycles and try to invest at the best times to take advantage. So we're going to look at that in this video. I'll leave resources and everything I talk about in this video will be down in the description, and I'll leave timestamps for all of the different sections down there as well. The first thing we're going to look at is on-chain analytics. On-chain is unique to crypto and it is an absolute gift for us because as retail investors, we get to see this fundamental data that we don't see in any other asset class. The fundamental thing here is that crypto, and I'm going to refer to Bitcoin mostly, is in a secular uptrend. So it is growing over the long term. It's attracting users fundamentally. In between that, we know we have price cycles. So the price cycles are short up and down, but the long-term secular growth is to the upside. That's what we can take advantage of, is when prices are low, we're buying, and when prices are high, we're selling. Sounds simple. Most people get in at the top of a bull market and then give up. So really we need to educate ourselves into the price cycles, knowing that those bull markets, those bear markets will come, and that is the time to invest. So how do we take advantage of those price cycles? If you're a day trader or a long-term investor, you need to know which part of the market cycle that we're in so you can take advantage. There's no point taking speculative long trades on a day trading scenario if we're in a bear market. You're going to get wrecked. So this is the fundamental. Let's see how we can predict those cycles. So we're going to look at firstly at realized price. This is an on-chain metric. Now, everything I talk about in this video, you can just see the links down below. Look into Bitcoin is free, so I'll link it below. The exchanges that I use and all of the other resources that I use, I will link all down in the description. Look into Bitcoin, so go to this website and then go to realized price. You can search up here. Realized price, as you can see here, takes the value of all BTC at the price they were last transacted on chain divided by the number of Bitcoin in circulation. It gives us an average cost basis at which all Bitcoins were purchased. What we can see here is that Bitcoin is in a secular uptrend, right? So if you take away the Bitcoin price, this is the average price at which the market has transacted in Bitcoin. And this generally goes up in bull markets, as you can see, and then kind of stagnates for a few years, goes up again, stagnates for a few years. So where do you want to be buying? You want to be buying during this stagnation phase, waiting for the up phase, right? So that's what we want to do. So realized price is just very simply the kind of market price for BTC for long-term investors. So if we put the price back on, what we can see is that if the actual market price that you can buy Bitcoin now for is below that, that is typically extremely good as an entry price for buying Bitcoin, right? So we're going to go back to 2012. The bear market here, when the actual price falls below the realized price, it's time to buy. Typically, that's when most people are selling for some reason. So a bear market, people sell, they get worried, they lose confidence. That's the time to buy BTC, given we assume this has a secular growth trend for the long term. You can see realized price here, falls below it in a bear market. That's time to buy. Falls below it in a bear market, that is time to buy. The most recent bear market fell below it, that is time to buy. The only way you make more money than other people with Bitcoin is buying at a lower price than them, which means you have to be active and accumulating in a bear market. We can also see trends of these, bull and bear markets as well, right? So there's lots of different ways to look at this. Realized cap is pretty much the same thing, right? You're looking at long-term versus short-term. During bull markets, short-term investors or speculators take over. They rush in, they buy, force the price up, they want Bitcoin. That's fine. We can be part of that to the upside, but that is, the worst time to buy is when it's peaking. So as you can see here, when short-term investors peak, they're pushing prices up. That's when we can let some go. During bear markets, as short-term investors come out of the market, prices come down. That's when we need to be active. We need to take advantage. We need to be on the right side of the cycle. If you're on the wrong side of the cycle, you're going to get wrecked. Buying at highs, scared at the lows, selling out. It's not how professionals do things. Have a long-term plan for at least 2 cycles, right? Which is 8 years. 8 years, 2 cycles. Buy both bear markets, and then we can do what we want in the bull market. we can see this capital rotation as it happens, right? During bull markets, as you can see, there is a massive swing low of, realized capital, right? Rotation. So during bull markets, that's not the time to invest. During bear markets, that is the time to invest. So we can see that over time. We can also come and see this capital rotation, right? So as you can see, bear capital rotation, speculators over hodlers, right? So during bull markets, that peaks up. We don't want to be part of that. We want to be part of the, clever money who are buying in bear markets and selling in bull markets and being the right side of the cycle. We can see that as speculators pour in, they push the price up. That's when long-term investors can let some go, and then we accumulate back in bear markets. 2 cycles you've got to be in if you want to make that 10x of your portfolio, buying both bear markets, right, and then selling some to speculators at the top of a bull market. We're going to look at something else, which is net unrealized profit and loss. This actually takes realized cap as well, I believe. So it's a similar thing, but it basically gives us like a score of where the Bitcoin market is. So obviously during bear markets, most of the Bitcoin market may be in a loss or a capitulation. During bull markets, most of the Bitcoin market is going to be in a profit. And so we can see how this works over time. So we have the blue right here. Now, as we can see, where do you want to be buying during capitulation? So bear market here, and we had the bear market here. Let's put the price back on. You can see how that works. Bitcoin price lows, Bitcoin price lows, Bitcoin price lows. That is where to accumulate. So you have that long-term plan over 2 cycles, so 8 years. Invest during bear markets. If we assume Bitcoin keeps having its secular adoption, that is the time to invest. And when the price gets up to euphoria and greed, when we're hitting new all-time highs and everyone's saying we're coming in, that is when to either let some go or scale back. We'll get onto dollar cost averaging and how to do that in a second. Let's also look at this. It's the same thing. Again, all of these resources I'll link below. These are free. This is realized price again, but it just gives us a very easy chart to look at. When the realized price is moving into blue, that is moving from a bear market, and the price is recovering up into an expansion phase. Because remember, this network is growing, and so the price cycle has to have expansions. If the network is growing over time, there's nothing else that can happen that the price has to go up. If the network expands, the price has to go up. That's how it's designed, right? Anything, you look at any asset, if it's growing, the price goes up. Bitcoin is growing, and so as we can see, as we come out of these price cycles, which are short term, you get this blue color here, which is the expansion again. That is the time to buy. Bottom of the cycle, expanding out in blue, and then you ride the bull market. You have the blue here as well, which you're expanding out. The blue here where you're expanding out. Right now, as of making this video, we're just turning blue, looking to expand out again. So the best time to invest is during that bear cycle. And if you're new and you haven't had that bear cycle, consider waiting for it whenever it comes, because they will come and they're the best times to invest. You have to plan for that. There's no point going in too quickly into something and saying, I just want to get an allocation if you're at the peak of each cycle. That's not how you can do things. You have to be very strategic when you're putting your money in. MVRV is exactly the same thing. It's showing us where prices are overdone on the bull side and the bear side. So again, it's just looking at realized price or realized cap and giving us a kind of Z-score of it, right? So giving us how is it inflecting. When the price is at highs in this red zone, worst time to buy, absolute worst time to buy. We can see each of these cycles, 1, 2, 3, 4, each of those where the price comes down and the Z-score of it, right, showing us how it's inflecting, comes into this buy zone. 1, 2, 3, 4. We're in a buy zone here when the price was at 15, and now we're moving out. You want to be buying and accumulating during this part of the cycle and either just slowing down, or if you want to, you can sell at that part of the cycle. So we'll get onto that in a second, as you can see here. Another way to do this, very simply, is to look at technicals and just look at a 200-week moving average. This is TradingView. It's a free software, so just sign up for an account. I'll link TradingView down below as well. It's free to use. There's a pro version, which you probably don't need, so you can just use it for free. So come up here and search for a Bitcoin chart. I have Bitcoin, so BTC USD here in crypto. We're going to look for this, which is the all-time history index, so we can see the price, so we can see it from its very start. What I do then is go to indicators, just type in the word simple, moving average simple here. Then go over to the indicator, which is this one, just type settings, go to inputs, and then type 200. Press OK. Just make sure you're on the week chart here. So each candlestick is 1 week in length. So each one of these red and green candlesticks is 1 week. What we're now doing is looking at a 200-week moving average of the price of BTC. It's one of the biggest uptrends I've ever seen in my life. I've been trading and investing for like 15 years at this point, and this is just absurd. I've never seen anything like this, right? It is literally just a pure uptrend, as you can see here, over a very long time period. I'm looking on the logarithmic chart. So if you come down to the bottom right, just below my head, click on the icon here. You want logarithmic, okay, not regular. You want logarithmic, which looks at long-term trends. So what we can see is that the long-term price trend, the moving average, right? So taking out these short-term ups and downs, a moving average of the price over 200 weeks is plotted in blue. And it's very clear that we're in a very large uptrend. It's also very clear that whenever the price itself goes through a cycle of selling and bearishness, is the absolute best time to accumulate this asset, right? So during each cycle. Now, if you are a long-term investor that has a 20-year view, none of this matters, because if you have a 20-year view, you're buying here, right? It doesn't matter because the price is going up, right? It's a long-term trend. What I'm saying is if you're looking to, make that 5-10x in your portfolio through cycles, then you're looking for these bear cycles as the absolute time to invest. You must be investing there, right? Because that is when price is coming down to this longer term moving average and has typically bounced a lot from those moving averages, right? So long-term investing, if you're looking at 3, 4, 5 cycles, you're just accumulating. It doesn't matter. If you're looking for a 5 to 10x within 2 cycles, which is 8 years, you have to be investing during those downtimes and during the times when it's coming back into its moving average. These are the best times to invest. So technicals can do it, and also these on-chain metrics can do it as well. Hopefully that explains Bitcoin price cycles, at least to you, including that secular uptrend that we have. Other cryptos are, of course, following this similar trend as well. Now, this sounds very simple, but it isn't. It's very, very hard to pull off. It's like going to the gym, right? We all know what we need to do, right? Go to the gym a lot, eat well, rest, go to the gym, work out, overload when you go there each time, get better, get stronger. Simple, sounds simple, but it requires real dedication over long periods of time. We're talking about buying Bitcoin and dollar cost averaging over multiple years right here to get another multiple year payoff. If you really want to make big returns, that's where we're looking at, right? So what I want to get into now is how to set yourself up over 2 price cycles, which is 8 years, 2 Bitcoin cycles, to set yourself up to take advantage. So we know that we need to be accumulating when we are down from lows. So how do we know what to do right there? Well, as we can see, all of these metrics are telling us when we're down towards the bottom of a price cycle, these are the times to accumulate. Now, previous price action cannot predict future price action and future results. So everything here is with the assumption that Bitcoin continues to grow as a network. If it doesn't, then we're screwed. But let's assume that it does, right? Because it is growing over time. So what we need to do is have a plan to accumulate at those stages. Dollar cost averaging. So dollar cost averaging, you put a plan together where you put X amount of dollars or your fiat currency in at regular intervals, right? So dollar cost average, you put $100 in or whatever per week, or 500 per month, whatever it is, right? And that is what you do consistently over that time. Now, of course, that's very easy. If you're a long-term investor and you're looking to put this in your retirement fund and come back in 20 plus years, then you just buy every week. It doesn't matter. It doesn't matter if you're buying highs, because as you can see, the highs for each cycle are getting higher as well, right? And of course, a lot of the gains are earlier on, but there's more risk at that time as well. So if you're a very long-term investor, what you're really wanting to do, right, by dollar cost averaging and buying every week, is to make sure that your average price is the same as this chart. You are not trying to outperform Bitcoin. Bitcoin itself is the outperformance. So all you're looking to do is make sure that your average price, right, is basically this 200-week moving average, right? And so you're smoothing out the bull markets, you're smoothing out the bear markets over time. That is time, that cures all with the volatile asset, right? As long as it's going up, of course. But of course, we want to be more active. If you're looking to make money over shorter periods, how can you be more active? So let's have a look at this. Now, something to be aware of is that it has been proven over decades of research that active managers cannot outperform the market, okay? So if you're investing in the S&P 500, which is the American stock market, and that goes up 10 to 13% a year over the long term, or at least it has done. It has been shown that active managers over long periods of time, 10, 20 years, simply cannot outperform that. They cannot outperform the market. Bitcoin is the market as well. It's a financial index. And so if you're looking to outperform it, you may do, but you probably won't if you're looking over 20 years. But we can see these short-term price cycles occur, so we can be more active and definitely get in during times when the price is relatively to the downside, right? So this would be a very simple solution. You put $500 in a month or $100 in a month, whatever it is to you. When the price is below the 200-week simple moving average, that is a time to probably get more active. Below or near it, these are very, very short-term opportunities. As you can see here, we have these opportunities where it's advantageous to get in. Now that sounds easy too, but it isn't, because the reason the prices are down here is basically because of a slowdown in the economy or a slowdown or a recession or something like that, which is typically when people have less money. So it's not just as easy to say, put more money in now. You need to think about your entire lifestyle. You need to think about this 8-year plan, this 2-cycle plan of potentially having some dollars left over for these events, right? So we can see that in our dollar cost average. Below trend, I want to be buying, right? So it may not be for other people, but I want to be buying when it's below trend. What is trend? So this is my chart that I share with course members a lot. This is the natural regression of Bitcoin's growth over time, right? So I'm using a log chart, a logarithmic chart you can see here, and I'm just putting regression lines on the growth. So the growth is fast and then it's slowing down over time as the asset matures. But essentially I have the logarithmic regression of Bitcoin's growth. Then I have, a deviation to the downside and a deviation to the upside. Bear markets are where the price is down towards this lower bound. This is what I assume to be Bitcoin's trend rate of growth, right? So this is essentially, without all of the price cycles and everything like that, at the very bottom of its bear markets, it prints a price, and that can be connected from each cycle. That is what I consider the trend rate of growth. So that is just the Bitcoin network growing and having more users over time. And so that price is rising with that. Then the midline of it, right, which is, just the kind of average of its growth. And then the top line is where we get these big bull markets. So what am I doing? I want to buy when it's below trend. That is where you buy, right? That is where you make the money because you're buying low and waiting for those bull markets. So anything below this orange line, for me, I'm buying, right? That's my dollar cost average. I'm getting in, making sure I'm accumulating, I'm being regular. People are saying, is the price going to pull back? What's that? It doesn't matter. People are getting, excited over these tiny little candles when you're looking over an 8-year trajectory or a 12-year trajectory, right? It doesn't matter. These are the times that you're getting in, dollar cost averaging, making sure you're being consistent, and any dips, you're definitely buying those. The only way to make money and outperform is to actually buy when things are red, right? You can't wait to see what's going to happen. Be consistent during these times. So anything below here, I am buying. Anything below the 200-week, maybe I'm buying more and trying to put some in if I have that spare capital at the time, right? Because these very, very short-term events are the best times to buy. Anything under this orange line, I'm definitely dollar cost averaging as well. Now, when we're in a bull market, you can see these bull markets where we're getting above this kind of, regression line of growth. These are way overdone prices. What's happening here? Something's happening in the economy, right? The economy's hot. Maybe the central banks are dropping interest rates. Maybe the central banks are printing money, trying to stimulate the economy. These are when the central bank is saying, hey, pump up asset prices. That's fine, but these are bull markets and they don't carry on forever, right? Central banks, we know, tend to try and keep the rate of growth around 2%. And so when we get overdone in price, we would assume at some point it maybe comes back down to the trend, right? Or even lower, down to the bottom trend. So here, what are you going to be doing? Well, these are the areas where you can make that decision. So above trend, so down here it's like, emergency funds, right? You want to be going in. Here is your DCA. You want to be very active. Above trend, that's up to you, right? When you're looking above this trend here, you're saying, well, where is the price? If we're very close to this level, maybe continue my DCAs. As we move up, what do you want to do? Do you want to maybe, lay off? So you're going like 50% of your DCAs at that point. So you're actually buying less Bitcoin or crypto during that part. And maybe the cash that you were buying, you're putting that into stable coins. And you're putting it on like Aave, right, in DeFi, or you're just putting it in the bank and making sure that you're earning the treasury yield on it, 2%, 3%, whatever it may be at the time. And so it's not terrible to buy at these levels, but these are the higher levels, right? So again, it depends on your time frame. If you're looking for that 2 cycle time to actually make money, then you need to try and be more active trying to trade cycles. If you're looking for more than 2 cycles, 3, 4 cycles, even buying at these tops, okay, the price is going to be above that if you expect the trend rate of growth of BTC. Why is that? You can see this price here is 12,000, right? Not a good time to buy, but if you wait for the next cycle, the top was 69,000. So here, as long as you're happy to wait, then you still would have made money. But of course, for more active traders or investors, these are the times when you're like, whoa, okay, let's just back off a little bit, right? Things are getting overheated. So again, it's up to the individual whether they just want to invest through the whole thing or they want to pull back at that time. The blow off top is these things, right? The top of each cycle right here, these things, look, you want to try and avoid buying those, right? Now, again, it's up to the individual. During the cycle tops, do you want to take profits? If you want to take profits, if you're looking for that 2 cycle in and out, then you have to take profits during those peaks. If you're a 10 cycler, 20 years investment, whatever it is, then you just keep investing or you invest a little bit less. So that's up to the individual, right? But these are the cycle peaks where you're looking. So, definitely buying, dollar cost averaging, maybe taking some off the table in terms of your buys. And then here you're looking to either take profits or just stop dollar cost averaging because you're waiting for the next down cycle in price. Many people don't want to invest in Bitcoin. They think that the percentage gains they might be able to get, maybe 2, 3, 400%, it's not going to change their life. They have too small of an amount to put in. I fundamentally disagree with that, really, because it doesn't matter how much money you have, you just have to invest in the things that are growing, the things that are the best investments, right? And then just, consistently get into them over time. Now, a lot of people want to try and speculate on the more, speculative stuff and try and get those big gains in altcoins and everything like that. So what I look at is the risk curve. So as we know, in every market, there is a price cycle, right? So you have the price cycle with expansion, and then you have the price cycle with contraction. During a contraction, Bitcoin is volatile enough, it can drop, 60, 70% from its all-time highs, right? During that time, all of the other risky stuff is going to go down 80, 90, 95, 99%. So if you are looking to take risk, right, you need to do it at the bottom of price cycles. There's no point taking risk on NFTs and meme coins during the peak of bull cycles. It's just not the time to invest in those things. There is extreme difficulty here because of what this is. This is the risk curve, right? So within price cycles, as you get a new bull market coming into effect, the least risky stuff is going to start to outperform first, right? So Bitcoin usually outperforms first. You usually get the price cycle starting to pick up in Bitcoin. As Bitcoin starts to outperform, people are starting to make money in Bitcoin. They start to feel more comfortable taking more risk. And so the risk curve, they move out on this risk curve and start investing in more speculative, smaller things. That pushes the price of those up mid to late cycle. right? So price cycles, this happens for everything. If you look at the bond market, you have treasuries, the US debt, right? Usually at a peak during the contraction phase. Now, as the economy slows, interest rates come down, and that is actually bond prices going up. As bond prices going up, those bonds are outperforming, right? So people that have bought bonds as a trade low and the price goes up, they start making money, and that's the treasury yield. As treasury yields go down, suddenly you'll see out on the risk curve, right, which will be treasury yields here, you'll see junk bonds and other rubbish debt, right, with very high yields, they'll start to go down in yield as well, so up in price. So they start to get bid up. That's in bonds. We do the same thing for crypto. As Bitcoin starts to rise, as ETH starts to rise, people feel like they can take more risk. They start looking for the next thing that can go. Maybe that's L1s, alt L1s, maybe that's applications. And then towards mid and late cycle, you're looking at, that real stuff that comes about. Now, the risk here, you can't just say, I'm just going to buy loads of NFTs and memes at the bottom of a cycle. That doesn't work, because over cycles, what happens is that, you separate wheat from chaff, okay? Cream rises to the top over time and all the detritus falls to the bottom. The reason why you can't just invest in the riskiest stuff as it has come down is because 99% of that stuff won't come up again, right? So if you're looking over 2 cycles, what you need to do is at the very bottom of a price cycle, when we are bottoming out, when we're starting to recover again, is if you want to take more risk and you think that something can explode, in percentage terms, a lot more than BTC, you have to go out on this risk curve, but it's just uncertain. Like if you want to buy meme coins, if you want to buy NFTs, if you want to buy apps, then, some of those will not rise again and some will. So it's up to the individual whether they want to take more risk down there or they just want to stick to here, right? Of course, a TradFi investor would look at Bitcoin and ETH and call them extremely risky. We're calling them, basically not risky compared to the other stuff. But this is the risk curve, is that the expected return has to go up where there is more risk. Risk is not volatility. It doesn't mean something can go down 99% and up 1,000%. The risk is that it goes down and stays there. The risk of loss, right? Bitcoin has proven over 15 years that it's obviously growing as a network. So what you want to look at is if there are more risky things, if there are things that are way down in Bitcoin terms, they're going to outperform towards mid to late cycle after most of the gains have come in the less risky stuff. So that's up to the individual. You can play the price cycle purely in Bitcoin, or you can set up your portfolio to try and maybe, get some extra outperformance in the riskier stuff. The problem is in crypto, because it's so new, it's very uncertain what's going to perform, right? Probably not going to happen that meme coins are going to outperform again. It's going to be something else, right? It's going to be something else that comes about that maybe isn't even in the market yet. And so just know where you are in the cycle and know that even if you have something that's performing very well, if you're at peak cycle, if you're at late cycle, that probably will, no matter how demanded it is now, go down 80, 90%. So just be on the right side of the cycle and understand how much risk that you want to take. I would always say set out the portfolio. This is going to give a lot of percentage gains. And by the time you've bought NFTs and apps and everything, you've bought 10 of them, 7 of them don't go anywhere. A few of them do okay, but don't really outperform. One gives you that massive kind of, 700% gain, but the others have all lost, right? So by the time you've done all that, you might as well just invest in BTC. That's my opinion on it anyway, but that is how to try and take advantage of price cycles with even riskier assets than Bitcoin and ETH. Taking extra risk in the bull market is what a lot of people want to do because they want to chase those results. So the first thing is we need that long-term plan where we're just investing in secular growth. Now, instead of going out on the risk curve and buying memes and NFTs and God knows what else, what professional investors may do is just look to try and time the market a little bit more in the bull market and try and place trades where you get drawdowns within bull markets. So again, what we're doing is trying to figure out, are we in an expansion phase for the price or not? Once we know that we are, or within that phase, you can then look and say, if there are any drawdowns, that is when I take risk again. So it's the same as the cycle playing out, right? If you do it over a 4-year period, You're looking to take risk when others aren't. You're looking to take risk and buy when you're getting those drawdowns. And it's the same for the bull cycle as well. I'm talking about a mini cycle here where you're getting, much shorter drawdowns within an uptrend. So Bitcoin can regularly draw down 20% or so, even in uptrends, right? You can see this huge stonking bull market here. You're getting 20% drawdowns, right? And then you can see the previous bull market, you're getting huge drawdowns of 30% or so, right? And this was the pandemic, which is a huge 60% drawdown, right? So even within uptrends, if you're looking to be more active, you can more actively trade and day trade. Right now, I've got a load of day trading strategies and trading videos that go through everything about that. So I'll link them below. But essentially what you're looking for with this, when you're trading short term, is to take advantage of pullbacks to support levels or pullbacks of some amount where you think that's where we're taking risk. You know that the trend is probably to the upside. So whenever you get pullbacks like this, that is actually when to take risk, right? On the 3 pullbacks that Bitcoin has had in the most recent price cycle, right, which is these 3, right, you would have been getting in around 20K here, 25 and 25, right? And so you're just trying to take risk when others aren't. You're trying to enter positions during pullbacks if you think you're in an uptrend. Now, the downside of day trading and trading with leverage especially is that because Bitcoin is so volatile and the world is unpredictable, you just don't know what's going to happen if a 20% move is going to then bounce, or if a 20% moves into a 40% to the downside move because of a pandemic. So that's why when you day trade and take leverage, you can do that. But risk management is absolutely the most important thing. You have to have stop losses when you day trade. You have to know your ins and outs. And so I go over that in the day trading videos, which you can watch. I'll link them all below. That's really the fundamental basis of trying to put a 10x portfolio together. It's not about speculating over days or weeks. 2 price cycles, 8 years, you can do that. So you can check out the Crypto Investor course, which has this in 300 videos step by step, plus all of my latest research. All of the resources that I use, I'll link them in the description as well. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.